Good morning. How is everybody doing today? I hope you're doing good. Like I've told you in the past, I record these webinars on Thursday afternoon, so it's not a live webinar. But if any information comes out after Thursday, obviously it wouldn't be part of this webinar presentation. I hope everybody's doing all right. Today we are going to do a couple things. We're going to do a quick PPP update. We have some new information this week that I'm going to cover briefly. But then I'm really going to dive a little deeper into the 2021 Employee Retention Credit. I've gotten a lot of questions from people regarding the credit. It's completely different from the 2020 Employee Retention Credit. That's the one thing you've got to remember, because there's going to be a lot more people, I believe, that will qualify for the Employee Retention Credit in 2021 that may have not qualified for it in 2020. So we'll cover that briefly. And then I saved one last thing for the very end of this webinar that's strictly for self-employed individuals. So if you are self-employed or you're a CPA or an accountant that works with self-employed individuals, stay tuned obviously to the end of this webinar, because I'm going to cover a short topic on those people as well. So getting right into the program here, the webinar, we've got a little plug, obviously, for our PPP Excel workbook that we still are maintaining. It's version 2.0. It's still current. There hasn't been any new guidance from the SBA really to speak of. I think the SBA is probably a little overwhelmed with the processing the forgiveness applications, processing new loan applications, and then trying to come out with new portals to accept the forgiveness applications for the changes that were in the law that was passed or signed on December 27th. Because we're going to be talking about the Employee Retention Credit, the Employee Retention Credit Guide that Alan Gassman's office produced is fabulous. It's still really the best resource I can find that gathers together a lot of great, easy to read and easy to understand information regarding the Employee Retention Credit, and also what available resources there are. So that's probably the best part, or one of the best parts about this book, is there's well over 100 pages of resources and documentation and so forth. So it's really the one place where you can get all that kind of information. So they will probably update this book as we get more guidance from the IRS on the Employee Retention Credit. We haven't gotten any new guidance really yet, so stay tuned for that. And there are some open-ended items that we're going to have to get some guidance from the IRS on pretty soon, because it's affecting the 2020 tax returns that CPAs and accountants are preparing right now. So we're all kind of in a little bit of a state of limbo as far as that's concerned. So getting right on to where we're at on the PPP program, and I'm going to just spend a little bit of time on this. On Monday, President Biden announced that the SBA was going to make some changes to the PPP second draw loan program. And while the changes seem pretty subtle, there is one that's profound, and that is that the SBA is going to allow self-employed individuals to obtain their PPP second draw loan based on their gross Schedule C income, not their net Schedule C income. So if you remember, on the PPP loan, previously, the loan was based on line 31 of your Schedule C. That's the net income from your Schedule C after your expenses. Well, I guess the SBA, and particularly the administration, recognize that there's a lot of self-employed people who don't really make a lot of money after their deductions. And so therefore, basing their loan on their net income wasn't necessarily fair, because a business who got their loan based on payroll might have not had a profit, might even had a loss. They would have still qualified for a loan because they had payroll. So I think that was the logic that was being used here. It throws a really big curveball at us, because the loan amount now could be substantially higher for a self-employed individual, or let's say the self-employed individual had a loss on their Schedule C. Maybe their gross income was $50,000 and their expenses were $60,000, and they technically had a loss. They would not have qualified for a PPP loan previously. now they'll qualify because the loan will be based on the $50,000 of gross income. So this is a significant change. Now here comes the question that this automatically generates. What if I'm a self-employed individual who has already obtained my second draw loan? So in those circumstances, we don't know the answer yet, but I'm afraid those self-employed people might be out of luck. I'm hoping they won't be. I'm hoping that the SBA and the lenders allow them to amend their application and get more PPP second draw loan, but we don't know the answer to that. I'm certain that you cannot amend your first draw loan and get a larger loan, primarily because the emphasis on this new change that came out, essentially announced on Monday, was referencing the PPP second draw loan program. So I think that that's the main issue there. The other big issue on Monday was that starting yesterday, yesterday being Tuesday, or Wednesday rather, February 24th, there was going to be a 2-week moratorium on processing PPP loans for businesses with more than 20 employees. So I think that that was the SBA's way of making sure that smaller companies didn't get edged out of the PPP second draw loan program. It's interesting to point out that the second draw loan program has been a fairly slow process. I think the SBA is taking more time and going very slowly with respect to approving the loans, and they're checking them a little more carefully. As of February 21st, there had been close to 2 million loans approved for about $140 billion in total loan amounts. That averages about $73,000 per loan. The original loan program had about 7 million loans that were for $663 billion for an average of about $94,000 per loan. So that already tells me that these loans are going to small businesses. So I'm not really sure if the SBA needed to do this or not, but they must have felt, at least the administration felt compelled to do this. Now, if you're a borrower that is applying for second draw PPP loan and you have more than 20 employees, you're not necessarily left out, you're just kind of on hold. What I've told a few people this week is get really friendly with your banker and make sure that they kind of get you back into the queue as soon as they can, which will be 2 weeks from yesterday, or 2 weeks from February 24th. So just kind of keep that in mind. The SBA did publish this information on their website. It's really simple. It's a one-page, essentially one-page announcement. The other changes were minor. It had to do with allowing owners with non-fraud felony convictions to apply for the loan. It allowed for people that had issues with student loan delinquencies to apply for a loan. And then it also provided that non-citizen small business owners that are in the United States lawfully can possibly apply for the loan. So I think there was just a little bit of expansion to small and micro businesses that the administration was trying to accomplish here. But back to the self-employed individuals, that's the biggest issue here. If you have not applied for a loan, or maybe you had a loss previously, so you couldn't apply for the loan, now you might be able to apply for the loan. So make sure that you look at that and see if it's worthwhile for you to go ahead and get a PPP second draw loan. Now we're going to kind of get right into the employee retention credit. This is the 2021 employee retention credit. You got to get in your head that there's a big distinction between 2021 and 2020. And so I'm going to go over the rules. I'm going to go over some details. I might dive into some of these specifics a little bit deeper in future webinars, depending on the feedback I get from you guys as to topics that you'd like to have me address a little more deeply. So today we're going to stay a little bit higher up, overview approach. I might dig a little bit deeper in a few things, but I think it'll give you enough information to at least get the ball rolling with respect to the employee retention credit. Dolly Parton had a song that said, here you come again. And that's kind of how I feel about ERC and even PPP round 2. It's like just when we thought things were kind of starting to settle down, stuff's bubbled back up, and we're all very, very busy with all of these issues going on. So that's kind of my theme for the week. So with respect to the employee retention credit, really any company can qualify for the employee retention credit. There are some rules that relate to companies with more than 500 full-time equivalents, FTEs. Those businesses have a different set of rules where they can qualify, what wages qualify for it. But if you're 500 or fewer FTEs, then you really get a great opportunity here. The other criteria for trying to get or qualifying for the employee retention credit is that the company has had to have had a significant decline in gross receipts. Now for 2021 ERC, that's a 20% or more decline. That's not that significant in a lot of cases, but that's the number that Congress set, and that's the number we're stuck with. That is a huge difference compared to the 2020 employee retention credit, which required a 50% or more decline. So if you didn't qualify for the ERC in 2020, it doesn't mean you won't qualify for it in 2021. You really have to look at that. The other criteria that you can qualify under is if your company is subject to a partial or full shutdown order. So we'll get into that a little bit more in a few minutes, because there are still a lot of spots in this country where there are regional or statewide partial or full shutdown orders. The state of Florida, I believe right now, we're pretty much open completely. I know there might be some jurisdictions down in southwest or southeast Florida, the Miami area, that might still have some limited local restrictions. I'll talk about that in a few minutes. The restriction doesn't have to be statewide or nationwide. It can be as something as small as like your city or township. With respect to the employee size rules, I just mentioned a few minutes ago, if you have 500 or fewer full-time equivalents, those are FTEs, then you get to take the credit for all wages you pay your employees. All wages. Doesn't matter if the employee was working in the business or not. So if you qualify, you have 200 employees, you're gonna likely qualify for wages on every one of those employees. This could be profound. If you have more than 500 FTEs, then you can only take the credit for wages that are paid to employees that are not working in the business. So if you've got employees that you've kept on the payroll, but they're not working, or you're paying employees that are working part-time, but you're paying them full-time, then you're going to be able to qualify for the credit for any of that extra compensation that you're paying them. The FTE definition is an employee that was working an average of 30 hours per week or 130 hours of service per month, and you average all the 12 months of 2019, you essentially use the same guidance and rule that the Affordable Care Act uses to define an FTE. So you do need to take a look at that. And the other important thing with respect to your FTE calculations is the affiliation rules apply. So if you have multiple companies that are commonly owned, you've got to look at the affiliation rules to see if you exceed that 500 FTE count or not. You can't look at individual companies and just what the employees are under that one company if the companies are meet the affiliation rules. We could dig into that a little bit deeper in another webinar, but for the most part, everybody seems to be figuring that out based on the related party rules and the affiliation guidelines that there are. With respect to the qualification here, if you have a significant decline in gross receipts, that's, like I said before, 20% or more decline in gross receipts. Gross receipts really is pretty much your total revenue, net of any returns and allowances, plus any investment income the business might have. That's not very common, so it's really your revenue that you probably need to take a look at. But I do want to point out that it is net of returns and allowances. There's specific guidance in the IRS FAQs with respect to that. So if you have any types of adjustments for that, make sure that you deduct it from the revenue number. Now, the decline measurement gets a little wonky here because there is a traditional comparison, which is Q1 2021 to Q1 2019 for the first quarter of 2021 to see if you qualify for that 20% decline. But you can make an election to actually use the previous quarter. So that would be Q4 2020 to Q4 2019. And the reason why that's really important is, I'll get into it in a minute, but if you know you already qualify based on your fourth quarter 2020 revenue or gross receipts, then there's some actions you could be taking right now that could get you some of that employee retention credit faster, as opposed to waiting until you file your payroll tax return. I'll get into that in just a moment. We do know that the employee retention credit for 2021 covers right now Q1 and Q2 of 2021. So for Q2 2021, we have the same issue. You measure Q2 2021 gross receipts to Q2 2019 gross receipts, or you can measure Q1 2021 gross receipts to Q1 2019 gross receipts, because that's the quarter preceding Q2. Little confusing. I don't know why they needed to do that, but it certainly is going to help, because if you know you already qualify going into Q1 or going into Q2, like I said, there's some actions you can take to take advantage of getting that credit sooner, and I'll talk about that in a minute. The partial and full shutdown rules, this is probably the hardest area to really evaluate. And I've seen this in the last 2 weeks. I've fielded probably 30 or 40 phone calls and meetings from people who have asked me, I'm in 3 states, and one state I'm completely shut down, and one state I'm partially shut down, and another state I'm not shut down at all. Is my business subject to it? And there is some guidance if you read the IRS's FAQs that get into partial shutdowns, but generally speaking, if there is a modification to the operations due to the shutdown order that has more than a nominal effect on the business operations, you probably qualify. Now, the IRS didn't do a service here because they didn't define nominal effect. But if you look up the definition of nominal means a sum. It doesn't mean a lot. It doesn't mean 50%. It doesn't even mean 20%. So we're kind of in the gray area there where there's some subjectivity. And I think that's where you really need to look at the facts and circumstances. So for example, in that case I just gave you, where a company is fully shut down in one state, partially shut down in a second state, and not shut down at all in the third state, if they're being able to maintain operations corporation-wide or company-wide, and their revenue isn't down by more than 20%, maybe their profitability isn't down, then you really have to determine very subjectively, am I being nominally affected by the shutdown orders? And that's, again, a gray area where we're hoping to get a little more guidance from the IRS on this, particularly given the fact that there are some businesses that could start getting this credit like right now. So it'd be nice if we could get some more information on it. But as long as you do your due diligence and you have gathered the information to support your position for qualifying under the partial or full shutdown rules, then I think that's the best you can do. The IRS's FAQs and the IRS's website do give a few examples. So look at those to see if maybe you can rely on the example. Remember, the IRS's FAQs is not guidance that we're supposed to rely on, but right now it's really almost all we have when it comes to the employee retention credit. I want to clarify a couple misconceptions. These are things that have popped up repeatedly in emails that I've gotten, particularly in the last 10 days. A lot of people think you have to be losing money in your business to qualify for the ERC. That's not true. I've actually seen businesses that had a 50% or more decline in their gross receipts, but yet their net income was actually higher. And that's because they were cutting back on their overhead, particularly like maybe their payroll. So their profit might have actually been higher, but since they met the 50% or more decline in gross receipts, they qualify. So you don't have to be losing money to qualify for the employee retention credit. The other misconception is that you have to have the 20% decline and be subject to a partial or full shutdown order. And that's not true. The qualification is kind of an either or. So if you're subject to a shutdown order, you qualify. If your gross receipts are down by 20%, you qualify. So then the question becomes, well, which one do I use to calculate my employee retention credit? And the obvious answer is use the one that gives you the highest credit. So for example, if your business was subject to a shutdown order from, say, April 1st to April 30th, okay, that's 1 month in the second quarter of, say, 2020, you would qualify for the employee retention credit during that period of time. But let's say that your business for the second quarter of 2020 was down by more than 50%. Now you qualify for the entire quarter of second quarter of 2020. So clearly, you'd probably be better off using that qualification than the shutdown order qualification. So kind of keep that in mind, that you really have to look at where you're going to get the, say, biggest bang for your buck, if you will, on calculating the credit. And the other item that still is misleading is that if you receive the PPP first draw or second draw loan, you can still qualify for the ERC. You just can't use the same wages for both. And so what we've learned in analyzing this is it really boils down to the timing. When you report the PPP wages for getting your PPP loan forgiveness, and what rate wages you use for your ERC. And what I've learned is you almost have to do it on a timeline, and you almost have to do it per employee. So it's a very time-consuming process, but if you do it right and you have enough payroll to get your PPP forgiveness, any payroll you didn't use for that can now be used for the ERC if it's in a period in which you qualify for the ERC. So it's all about timing, everybody. How much can the credit be? This is where a lot of people, I think, have an aha moment when they see just how big the credit could be. The credit's based on gross wages and group health insurance that are paid by the employer. So don't forget that you can include group health insurance in the credit amount. It's still capped per employee based on that total cap of $10,000 per employee, but you can use health insurance and wages. So back in the PPP conversation for just a moment, you can use group health insurance there as well for group health insurance paid by the employer. So again, that's a situation where you've got to be careful not to double dip and use the same expense for both the credit and the PPP forgiveness. But here's where the 2021 employee retention credit gets much more generous. The $10,000 per employee cap is per quarter for 2021. So that's $10,000 quarter one, $10,000 quarter two. The 2020 cap was $10,000 for wages paid for all of the year. So even if you had an employee that made $10,000 a quarter and you qualified for each one of those quarters, you couldn't take any more than $10,000 of qualified wages for that employee to get the ERC for 2020. For 2021, if that employee is paid $10,000 in quarter one and $10,000 in quarter two, you get it in both quarters. The credit rate is an astonishing 70%. So let's do the math here. If I have that employee that I paid $10,000 in quarter one, 2021, and quarter two, 2021, I'm going to get a $7,000 per quarter credit for those wages. So you got 100 employees that all make that much money. You now have a $700,000 credit. It's ridiculous, but that's where these numbers are really getting large. So keep that in mind, that it's $7,000 per employee per quarter is the cap credit you can get. Wages paid to owners and their spouses seem to qualify. There hasn't been any exclusion for them, but there was an exclusion for related individuals. So if a husband and wife own a business and they have 4 children working in the business, right now, based on what guidance we have, the husband and wife's salary can be counted, but the 4 kids' salaries can't be counted. I think we need more IRS guidance on this, because I'm not sure if that's exactly correct. It doesn't seem to make sense that you would be required to exclude a working child or family member in the business, but yet include the owner's wages. So we'll get some more information on that eventually, hopefully. For right now, we're filing amended forms 941, 941X, and claiming the credit based on the current guidance we have. And that leads me into the next slide, and that is, how do you claim the credit? So for 2021, we have a couple options here. You can kind of do nothing and wait until you file your 941 for the quarter and claim the credit then. And a lot of people are doing that, especially businesses that are not cash strapped right now. They're kind of waiting to see exactly how this might all fall out. So they might wait until Q1 2021 is over. They'll know their revenue decline number in case they didn't meet it for Q4 2020, and they can file for a refundable credit on their 941. You can reduce your payroll tax deposits to receive some of the credit quicker. So let's say that you have $100,000 in total payroll taxes for the tax deposits for the quarter. You know your credit's going to be $50,000. You could back off on your tax deposits and get the credit sooner. Just be careful you don't underpay your payroll tax deposits. And then the other thing you can do is you can file a Form 7200. The Form 7200, in the slide deck you get here, which will be emailed to everybody who registered for the webinar, you can click on the link here and it'll take you directly to the IRS's website. You can see that form. It's a pretty simple form, but essentially it's a form that allows you to get an advance payment on the credit. The IRS does say on their website to make sure that you use the January 2021 version of the form to claim the credits for 2021. There was a prior 2020 version that they don't want you to use. So be sure you're using the right version of the Form 7200. Only small employers, that's the employers with 500 or fewer FTEs, can request an advance for 2021. The deadline for filing the 7200 is April 30th for Q1 and August 2nd for Q2. Not quite sure why you would file a 7200 by that date if you're already filing your 941, except for the fact that the IRS might expedite the processing of the 7200 to generate the advance payment quicker to an employer. Just be careful you don't ask for more than what you qualify for, because you wouldn't want that to create a problem for you and have to pay it back. So really, those are your essentially three ways of getting the credit in 2021. I think it's going to produce a lot of questions for Q1 2021. If you have businesses that use like an ADP or a Paychex, those companies are going to need to be told what wages would have qualified for the ERC for the first quarter. And they're going to have to get that data from you pretty quickly. So if you use an outside company to do your payroll, don't wait till the last minute to provide that to them. Try to get it to them as soon as possible, make their life a little bit easier. If you do payroll returns for clients, same question. Ask those questions really quick. Don't wait until the end of April to find out whether or not they qualify for the ERC. The next topic, which is a bit of a surprise to some people. We've been given so much this year with the PPPs and with the EIDLs, and we've been told time and time again that all these stimulus payments and benefits are non-taxable income. The ERC is not one of those. The ERC is essentially taxable income because the deduction that you would normally get for the wages and the related employer Social Security taxes need to be reduced for the applicable credit amount. So going back to my example, if I had an employee that I paid $10,000 to for the quarter and I'm getting a $7,000 credit, I'm only going to be allowed to deduct $3,000 of that person's wages on my tax return. So the employee retention credit isn't as, say, generous as the PPP program, because the PPP program gave us the money, we paid the wages, we get a deduction for the wages, and we don't pay taxes on the PPP loan forgiveness. Here, the ERC is essentially taxable. Now, the guidance right now tells us that the adjustment to the tax deduction is in the period for which the credit was claimed. So if you are trying to claim a credit for 2020's tax return or ERC, you're going to need to make sure you reflect that on your 2020 tax return. If you've already filed your 2020 business tax return and you're going to claim an employee retention credit for 2020, you might have to amend that return. That's what the guidance seems to be right now. We're going to wait and see if the IRS changes their mind and maybe lets us make the adjustment in 2021 or later, because you can file an amended payroll tax return 3 years after the due date of the original return. So we have a lot of time to file amended payroll returns if need be. The last tax topic I'm going to reference here is whether or not the ERC reduces the Section 199A wages for the qualified business income deduction. And frankly, people, we don't know the answer to this, believe it or not. The Section 199 reference to wages tells us to use the W-2 wages, and there's some specific guidelines on that were published quite a while ago now on how to calculate that. And those guidelines reference W-2 wages. Well, the W-2 wages for that employee I mentioned earlier is still going to be $10,000, not $3,000. It just means we're only going to be allowed to deduct $3,000. So when it comes to the Section 199 deduction, which is the qualified business income deduction, it would seem to me that you would still be able to use that $10,000 wage number. That's just my perception and my interpretation of how the Section 199 deduction is calculated. We'll have to see if we get more guidance on that. If you've got a Section 199 issue that's going to be affected by the employee retention credit, then you might need to hold off on filing that tax return until we know the answer to that. Here we're going to talk just for a minute about the one thing that self-employed people need to be aware of, and that is this essentially could be a gift if you think about it from that perspective on your 2020 tax return. It's form number 7202. Form number 7202 is how a self-employed person will calculate the tax credit for sick leave and family leave that was provided under the CARES Act. So I've got a link to the form here as well in the slide deck. And again, it's just to the IRS's publications and the form number 7202. The bottom line is that if you're a self-employed individual that has net income for 2020 and you were out for sick leave for up to 10 days, you can get a tax credit for that time period. And actually the maximum tax credit could be $5,110. If you were out because you were caring for a family member that was either dealing with COVID or was a family member's son or daughter, I'm sorry, it's son or daughter, that is like they can't go to school or their daycare is closed because of COVID and you can't work and you're home taking care of them, you can qualify for up to 50 days under the family medical leave clause, which can give you a credit of up to $10,000. So these could be really big numbers for self-employed individuals. We've created a schematic, if you will, a spreadsheet of what questions you need to ask to determine whether or not you qualify for the sick leave or the family leave or both. Form 7202 covers both of those clauses. So you're more than welcome to use this. It's just an Excel spreadsheet that we created to use for the 2020 tax returns. But this could be a significant windfall for self-employed people. I just got off of a Zoom meeting before this webinar with a person who was actually out of work for 30 days last year, self-employed individual. So he'll qualify for 10 days of sick leave and get a tax credit for that. So it's a huge potential benefit for self-employed individuals. So please make sure you pay attention to that if you're self-employed or you're a CPA or accountant that does tax returns for self-employed individuals. I think I went over my time limit today. I'm sorry if I did. Try to keep these to as close to 30 minutes as we can. Please continue to send emails, questions. I try to stay current with those. It also gives me ideas on topics to present on our weekly PPP tune-ups. So I appreciate that. Otherwise, everybody have a great weekend and a great week. Thank you.